Welcome to this explainer, where we're going to dive deep into the recent performance of India's absolute most talked about equity fund to see what's really going on beneath the surface. Today, we're putting the Parag Parikh Flexi Cap fund under the microscope. Look, if you have any exposure to Indian mutual funds, you know this name. It's got a massive, almost cult-like following. But recently, well, the tone has definitely shifted from celebration to a bit of concern.
I know. A ton of you have been asking this exact question over the last month or two, as you've watched the performance just kind of flatline. The anxiety is palpable, right? Investors who are totally used to these stellar, market-beating returns are now staring at their portfolios, just wondering if the magic is finally gone. Is it time to jump ship, or is this just a temporary bump in the road?
The absolute core of this panic comes down to this single number, a negative 5% year-to-date return, while the broader market indices are out there cruising along just fine. When you log into your brokerage account and see a negative 5% while the rest of the market is basically having a party, yeah, it stings. It creates this immediate, heavy psychological pressure to sell. But in the world of investing, reacting purely to a short-term number without understanding the wider context, that is a really dangerous game.
And we aren't just talking about any fund here. At 1.4 lakh crore rupees in assets under management, which to put that into perspective is roughly $14 to $15 billion, there is serious money on the line. We're talking about one of the largest equity funds in the entire country. When a fund of this sheer magnitude starts to stall out, it creates huge waves across the whole retail investing landscape. For a lot of folks, this isn't just some minor portfolio tweak. This is the core of their financial future.
So to really diagnose this recent slump and figure out if it's still worth holding, we're going to objectively investigate three vital areas: the fund's massive size, its highly contrarian strategy, and its actual risk metrics. We're going to completely strip away the recency bias and look strictly at the data, the manager's mandate, and the underlying mechanics of the portfolio.
Section 1. The massive AUM factor.
Let's start with the elephant in the room. Size is often the absolute enemy of performance in mutual funds. It acts kind of like gravity, slowly pulling down astronomical returns. We're talking about a literal rocket ship trajectory in growth. Just 6 years ago, this was a 5,000 crore fund, but it's seen explosive growth, adding roughly 20,000 crores in just a 6-month window between 2023 and 2024 alone. That kind of exponential cash inflow is a double-edged sword. Sure, it's a testament to their incredible historical outperformance, but managing 5,000 crores is fundamentally a totally different sport than managing 140,000 crores.
Because the fund is now so incredibly large, the fund managers literally cannot deploy capital into small or mid-cap opportunities without it basically being a drop in the ocean. This forces them right into a predominantly large-cap corner. Think about it. If they find a brilliant small-cap company and want to invest 50 crore rupees, it barely even registers on a 1.4 lakh crore portfolio. And since they strictly maintain a very concentrated portfolio of just 30 to 35 stocks, they're effectively boxed out of the hyper-growth smaller companies. They kinda have to hunt in the large-cap space purely out of sheer necessity.
Section 2. A unique asset allocation.
But size is only part of the story. To really get it, we have to look at their highly unusual asset allocation. This isn't a normal FlexiCap fund. Notice how they only hold about 70% in domestic equity right now? Meanwhile, they're sitting on a massive 14% in debt, 12% in international equities, and even 4% in REITs. A lot of investors just assume a FlexiCap fund is going to be heavily, almost entirely invested in Indian equities. But Parag Parikh, they are perfectly comfortable sitting on cash or parking it in real estate investment trusts when they feel domestic equities are overvalued.
And when you compare that directly to its peers, who are generally running 95% in domestic equities right now, it becomes incredibly obvious why Parag Parikh isn't moving in lockstep with the rest of the domestic market. If the Indian domestic market shoots up, a fund with 95% exposure is obviously going to outperform a fund with only 70% exposure. It's just simple math. You cannot expect this fund to mirror the exact peaks and valleys of its category peers because, frankly, it's playing a completely different game on a completely different field.
Section 3. The Contrarian Value Strategy.
So let's diagnose the exact symptoms causing the slump. That negative year-to-date return boils down to three main culprits, especially the fact that they're betting heavily on sectors that the rest of the market is totally ignoring right now. We discussed the AUM scale, but consider the international side. Because of RVI restrictions on mutual funds investing abroad, all that massive new cash flowing in couldn't be deployed internationally. So that global edge shrank from about 30% down to 12%.
And finally, the specific domestic stocks they're buying are definitely testing everyone's patience right now. You see, the fund manager operates on a strict contrarian value philosophy. That means they are actively buying up out-of-favor stocks while other funds are out there chasing high-flying capital goods and power sectors. This requires an immense amount of conviction. It means sitting comfortably while everyone else points and laughs at your portfolio. You have to have the discipline to hold on to your thesis, even when the daily ticker is flashing red.
While the broader market absolutely hates IT and banking right now, this fund is doubling down on HDFC Bank, TCS, and Infosys. They're betting that patience is going to pay off in the long run. HDFC Bank has been a severe laggard recently, yet it remains their top pick. They're aggressively increasing allocations in IT giants like Infosys and HCL, sectors that the market is extremely pessimistic about. And they're holding nearly 14% in cash and debt because they simply refuse to overpay for momentum stocks.
Section 4. Low Risk, High Alpha.
So does the long-term data actually justify this patient approach? Looking at the calendar returns, we can clearly see a pattern of massive outperformance in years like 2020 and 2023. That easily balances out the periodic slumps like the one we saw in 2022 and the one we're experiencing right now. In 2020, they delivered a staggering 46.8%. They were literally the absolute best in their category for multiple years. This proves that their contrarian value bets do eventually pay off, and when they do, it's explosive. You just have to endure the quiet periods to actually participate in those massive upward revaluations.
Now, the risk data here is absolutely fascinating. With a beta of just 0.6 compared to the category average of 0.95, this fund is taking significantly less risk and experiencing way less volatility than its peers. Basically, a beta of 0.6 means this fund is 40% less volatile than the broader market. So when the market crashes, this fund acts like a giant shock absorber. Plus, their standard deviation, which measures how wildly returns swing up and down, is incredibly low at just 2.6, generating long-term market-beating returns without taking market-level risks. I mean, that is literally the holy grail of investing.
Because of the high cash, debt, and international diversification, you should actually reframe your expectations. View this almost like an aggressive hybrid fund designed to protect your downside. If you treat this like some high-octane growth fund, you're absolutely going to be disappointed during momentum rallies. But if you view it as the steady anchor of your portfolio, the ballast that keeps the whole ship upright when a storm hits, well then its current positioning makes perfect sense.
Section 5. Is it worth holding? So bringing all this data together, should you hit the sell button? The data tells us the fund's strategy hasn't broken. Actually, scratch that, it hasn't broken at all. It's simply undergoing a value-building phase that requires an immense amount of patience. This makes it a rock-solid core holding for long-term goals. The fund manager hasn't lost their touch. They are executing the exact same philosophy that made the fund incredibly successful in the first place, hoarding cash, buying undervalued giants, and totally refusing to chase the herd.
Instead of asking if the fund is quote-unquote good or bad, the real question you need to leave with today is whether your personal investment horizon is long enough to let this contrarian strategy work its magic. If you want quick 6-month returns, yeah, this isn't for you. But if you're building a portfolio for retirement or maybe a child's education 10 years down the line, this low-risk, high-conviction approach is incredibly rare to find. The strategy is working exactly as designed. The real question isn't whether Parag has lost its touch, it's whether you have the discipline to endure the boredom required to build true generational wealth.